So, we do a conference, and we'll tell you the dates. It'll be June 5th and 6th in 2017. But the very first panel is always financing. And it's always the best panel, and it's the one that people are paying the most attention to. This is if you can't get the money to build this thing, you're not going to build this thing.
Right.
Right? And so, guys like Mark, have worked closely with us, Mark Kane, his group, and we've gone into all the banks and talked to the lending groups there and so on. Is talk about how you structure finances. Let's talk about it at the simplest level, right? So let's say you can get 70% construction financing, right? So the deal is going to cost you $100 million to build, right? And that includes your development fee, all in, right? So you're going to get paid something to do it. So some guys go to 75%. It's got covenant on it. Sometimes, there's joint venture partners. Both of them put their covenant on it. Sometimes just one puts his covenant on it. He should probably be paid for doing that, right? So you get to 75%, okay? Now, so let's assume that you already own the land. It's already paid for. The land might be the 15% equity, or it might be, 11 or 12 or 8% equity, but the land will form the equity piece, right? We'll come back to the rest of the equity in a minute. Then you get mezzanine money, right? So mezz financing, you get up to about 15%, and that number's going to be, 9 to 11%, let's say, with a 1 or 2% fee, right?
And where do you get that from?
Well, you would get that from typically a secondary lender, right? But some guys are offering blended rates. Like Mark, you can do that, right? You'll blend construction financing and mezz together, and so you're going to pay more for the mezz, but you get a blended piece, and it's just done, right? A lot of life is just getting it done, right? Instead of spending all your money running around and so on, just go to the guys that do it and get it done. So if we think about that capital stack, so you got the construction piece for 75%, you got the mezz for 15%, and then for the equity piece, let's assume you didn't have the land, you had to go buy the land, right? So if the equity piece is $15 million, you could go find an equity partner to give you a piece of that $15 million. Fair enough? And he might give you $10 or $12 million of that money, and then you would have $2 or $3 million or $4 million in the deal, right? Plus, remember, you'd be getting paid a development fee and a construction fee. That, interestingly enough, would come to $3 or $4 million, right? They might have to upfront it and things like that. So if you don't have the money, but you put together the deal, then I think, and you can show them that, you're a solid developer, the areas, the city is good and the specific site is good, I think that there will be people that would finance you here. And and everyone's got a different thought. I mean, the construction guy just wants his money back. He doesn't really care how profitable the deal is. He's looking at your covenant and will I get my money back, right? The mezz guy's kind of thinking, in a sense, the same way. He's a little closer to the bone, right, in case something goes wrong. The equity partner's thinking totally different, right? He's thinking like you are, right? And but he might. So let's talk about the mezz piece is easy, right? 9 to 11%, 1 or 2% fee. You just the clock is ticking as soon as you get it. The equity partner, you got to really sit and talk to the equity partner, and I would say that the guy that has the gold makes the rules, right? So it's kind of like, so how does the equity partner participate in other asset classes? Because he's probably done a retail deal or an office deal or a hotel deal or something like that. What can he take to his credit committee that's going to play, right? And so that's the way that we try and structure it. Some guys are just saying, no, look, with 50-50 partners on equity, we're going to stand shoulder to shoulder. We're putting our covenant on it. You can charge a development fee and a construction fee to the deal, right? Some guys will say, no, we'll both get a pref return, right? So let's say of that 15 million, you both put in 7 million, right? You'll get a pref return, call it 6% on your money, so preferred return first, either from the cash flow or from the sale, but it'll accumulate, right? But then after this guy says, after I hit a 12% return, then the sharing won't be 50-50 anymore. It'll be 60-40 to you, the developer. And once you go to 18%, it could be 80-20, right? It all depends on sort of what their thresholds are. Some guys are just IRR driven. They'll say, once I get an 18% IRR, you can keep the rest, right? So it all depends on your partner and how comfortable you are. Certainly as a developer, your role is to get as little money in the deal as possible, right? And on your first deal, you might put in more money than on your second and your third deal, right? And I've been involved in I'll talk about a little later on, a 4-building transaction. It's a good-sized deal. And, once the first building got built and the developer over-delivered on it, the next 3 deals were easy, right? And so that's what I would say. This is very much a reputational business. It really is. And it's a tiny market.
Right.
right? I remember once having a developer who had an unbelievable amount of land. It's raining land in his office. Do you know what I mean? And I took him to really the ideal institutional partner. And they just made 3 calls and said, that's not our deal. And that's all they said. That's just not our deal, right? So it's important to have that track record. If you don't have that track record, build that knowledge base. It's not that hard. It's apartments, right? But it's important to do that.